Well, the Federal Reserve meeting this week largely kept the interest rates unchanged as was widely expected. However, the data and the commentary revealed something more valuable, what's coming in the coming months and quarters. My name is Sunil Grover, and I'm the founding managing partner of True Blue Partners. At True Blue Partners, through our venture fund and affiliated funds, we provide company building services to founders of enterprise AI companies to build the next generation of leaders. The key highlights of this week's announcements and data are summarized in this deck here. The interest rates were expected to be unchanged. The headline was really around what goes on with the tariffs. Tariffs, as you know, are expected to drive one-time inflation. The word transitory, if you recall, is no longer used in the Fed's vocabulary. It's one time. They are not going to assume that this is going to be a one-time event until proven so. So what will happen as a result of that? I believe the Fed has made it very clear that they're going to wait and see until the whole impact of tariffs passes. How long does that mean? Well, we just heard on April 9th that the tariffs have been pushed off for another 90 days, except for the small 10% piece. So we'll see whether that small 10% piece has any effect in these 90 days and how these bilateral discussions like the one announced with UK start taking steam. China went down from 140% to 80% tariffs, but that's clearly not enough. That's just an opening bid. There's going to be a round of negotiations. What is happening as a result of that is that the ports are not receiving any more shipments from China. And we'll take a look a little bit more into the detail what that could potentially mean. What it does mean very clearly is that there is no anticipation of interest rates until about September. So give it 90 days and then give it 1 or 2 months, and then we'll see. Now that could change, but today nothing's expected to go lower on the interest rates until September. Uh, Tariffs are like taxes. We've discussed that before. It's going to have a one-time impact. And this quarter, the GDP went negative because the imports increased in anticipation of tariffs. That clearly is going to be a one-time thing. The core PCE numbers are coming in steady at 2.6%. That is good. What is not as good is they're not 2%. That's where Fed wants to see them. Uh, Remember, it was 1.5% in Feb 2021. So 1.5% is pretty close to a 2% annual where Fed would be very comfortable. And that's why at 1.5%, Fed was very happy to keep the interest rates at zero, below 1.5%, therefore putting some fuel to the fire, the economic fire engine, if you may. Month over month, the core PC is at 0%, and the headline inflation CPI is at 0.1%. Those are both very positive numbers, but one data point a trend doesn't make. So will the tariffs cause a bump? Will that bump be one time or transitory? Headline inflation is trending downwards. Energy prices are declining. Crude is at $57 a barrel, but year over year, even the core PCI is at 2.8%, meaningfully higher than the Fed's target of 2%. The secondary mandate of the Fed, the job market, continues to be strong and is a regime priority. So I would expect that to stay healthy, which means that's a positive driver towards lowering interest rates. Valuations, meanwhile, have come down towards the end of last year, and then beginning of this year, there was a strong Trump bump. But now all that has been wiped off, and valuation, the way we look at it, is really revenue and EBITDA multiples for where it's relevant, whichever metric is relevant for those sections. AI and enterprise AI continues, to be the strong spot in the economy for investments and adoption. 60% is the decline of the shipments that come in from China to the US, and China accounts for 40 to 45%. So the net decline on the ports is in that 25% range. Now, will people be able to circumnavigate this? Now, keep in mind that will be illegal, but the international courts have a lot more things to deal with than who needs to pay for tariffs. And even when the embargoes on Russia and Russian oil was done, people were smart enough to figure out how to get around it, if you may. Russian economy is not hurting because they can't export oil. It's hurting because they're investing a lot in the war and for other reasons. So how much will this really impact inbound supply? Don't know. Today it is hurting, and many of the smaller retailers are feeling that pinch a lot more. The general understanding in the market is that all of this has to clear out before the shipments for the holiday season come in. Because remember, it's Black Friday. Black Friday is the day when all these retailers start making profit. If inventories are not there by Black Friday, if those orders have not gone in, that would really hit the economy pretty hard. Until then, I think it's fairly resilient. It should be able to wear itself out. Uh, so why do macro trends? I mean, why do we spend time once a quarter, once every so many months looking at these macro trends? Let's take a look at the way this trickles down. Investments, as you know, are driven by liquidity from previous investments. If I'm not getting liquidity events because of IPOs or M&A transaction, and keep in mind, both of them have been down ever since the interest rates have been as high as they've been. So then I can't invest as much in the next startups. That's okay, because as investors, we want to get in when the valuations are not overheated. Uh, GDP growth expectations drive the investments made by the businesses. That's okay, because enterprise AI is a hotspot. Companies realize this is going to be important for their competitive advantage. Well, they're not flooding the investment stream, which can happen if the money flow is lighter. But if they were cutting, they're not necessarily cutting back on AI investments, and that's a positive sign. GDP is driven, and the anticipation of GDP is driven by consumer confidence. Consumer confidence is if it softens, businesses investing for consumers to spend more will soften, which means investments in enterprise IT and therefore enterprise AI start to soften. And so interest rates driven by inflation and full employment levels drive the money flow in the economy, drives the investments, drives the performance of these companies, and all of this eventually drives valuations, which is very important for us to monitor if you want to make good returns on our investment. Another way to look at it, because most of our audience here, both entrepreneurs and investors, are engineering folks, is relative velocity. Think of these macro trends as being the flow of the stream or the medium in which the item that you're measuring velocity for is moving. Um, think of our companies that we invest in as these boats flowing in the stream of trends about AI and money, monetary flow, inflation, etc., being the flow of the stream. We don't, if we are going upstream against the flow, it will be harder. We are in that trend for macroeconomic factors right now, but the AI trends are working in our favor, and so that's the balance. We look at this as a skills game. The companies that we invest in are these sailboats, are these ships, hopefully become naval carriers in the future. The founders and the CEOs are the captains of the ship. We are the advisors and the coaches. We'll take a company building approach as opposed to the horse versus jockey, which is more of a gambling or a betting playbook. And there's a little bit of that you have to account for the uncertainties and things that you can't control and predict, but that does not make it a gambling game in our view of the world. Uh, In enterprise AI, what are the key highlights that are happening? We're hearing that 30% of the code at large AI infrastructure technology leaders is AI generated. Now, these are the Microsofts and NVIDIA of the world. They're expecting a lot of business to come in because of AI. So they have to almost say, yes, we are using AI. And the first place being the coding part. How much of that is a marketing tagline? What the reality is, we don't know, but the trend is very clear. Anecdotally, we are hearing 30% plus is actually being generated with AI. The measurable, predictable ROI cases are starting to emerge now. The headline that came out this week was from IBM, and IBM, being a leading provider of AI solutions, did announce that many of their HR admin processes are all being driven by AI. No longer are there many human jobs in those admin roles, and those jobs have all been, they were either already outsourced to a third party BPO, and those that were in-house have been transferred into other departments. We've heard that also in a lot of call center, support center environments, that the number of jobs there are declining, but the number of voice calls, interestingly, are going up because it's easier to talk to AI on voice than it is to type things out clearly. The cost of AI tools in services engagements. Now, remember, the vision is that AI is going to disrupt every service offering, whether it's consulting, investment banking, research, software development services. Each one of these services is going to get massively disrupted with enterprise AI solutions. And what is happening is that the cost of AI tools is starting to show up and is being accepted as part of the time and materials engagement services that these services companies provide to their clients. Clients are almost asking for that level of higher performance and productivity improvement, but it's a line item expense today that looks like 1% of the total consulting engagement. If it's $1 million engagement, $10,000 is the cost of AI tools. That's becoming very widely acceptable now, where the AI provides needle moving advantages as far as the business value proposition goes. The ability for the companies to pay more is higher, but those are the things that we are working on. In our business itself, the analysts and the associates who would use a lot of tools are using a lot of AI tools. So that is becoming part of the day-to-day work stream. Let's dig into the financial numbers. The core PCE, as we discussed, there was a little bump here in Feb, as you'll see, if you can see my mouse. But then, it's been 2.6% almost since May, fairly flatline, which is good. What is not good, it's not at the 2%. Typically, if you look at a process control, when there's a time delay, sometimes a steady state is formed with a known error from the target. And if that's the situation out here, that is not good. There has to be a disturbance done to get the interest rates lower than 2%, so it stabilizes again at 2%, where things were. If we look back, if we do a throwback on where things were in January, February 21, you can see they were at 1.5% of a core PCE, which is kind of a predictor of inflation. Month over month, core PCE did drop to zero, but it was 0.4%. This was a concerning trend. Well, that part of it has gone away, but then that leads to other concerns. There's always something to worry about in economics and finance. Headline CPI, clearly 3 data points do start making a trend. There was an upward trend. It's kind of coming down. Unfortunately, that also is coupled with lowering of Nasdaq and valuation and asset prices. So that's pretty consistent. You can see month over month numbers are on the headline inflation. Now this is not core, is zero. Non-core, which includes energy and food, is prices actually did go down because the crude prices went down. Shelter has also started coming down, which is a good thing. So Where will the interest rates be? Right now, nobody knows, but I don't think anyone's willing to bet that, or the markets are not willing to price in any interest rate reductions until we hit September. And we covered the reasons why earlier. GDP is an interesting data point this quarter because GDP went negative, and 2 quarters of negative GDP is a recession, and the trend is also fairly downward sloping. However, when we peel through that further and you break down GDP of its core components, you'll find that the imports really went way high, and this is because 40% increase in the number of imports in 1 quarter, correlated with the fact that the Trump is planning to increase tariffs, and everyone in the households that I know of is buying their electronics in advance and supplies in advance, and I've heard stories of toilet papers being stocked up, etc. Um, what is the fascination of toilet papers and American consumer is kind of interesting. But anyway, so that's happening. Uh, and that's going to reverse the next quarter is what we anticipate. What's interesting is that the investments has also gone down. Some of that is inventory, but when we look through the numbers, it's actually heavy equipment, and that could also be tariffs related. Get that heavy equipment in sooner rather than pay heavy tariffs on it. Uh, and this is the data that kind of brings it all together. Our interest rates came down, our valuations went up, interest rates have been flat, and now with all the tariffs and the uncertainty around maybe is this going to lead to recession, your valuations have dropped down at 8.1 times. That is for the SAS index that we track, or 4.5% for the Nasdaq. This is the revenue multiple. It's back to where things were in that Q1, Q2 of 2024. So the whole second half of the year lift, and whether you call this a Trump bump, it's all gone. Um, Labor market analysis again continues to stay very healthy. I mean, the 60% of employment population ratio is fairly high. Your quit rates and unemployment rates are at 4.2%, fairly steady and not too high. Your quit rates are increasing, which is good. Economy is strong, but these things can change. The number of people employed remains at an all-time high at 164 million jobs being fulfilled. So again, not something that says recession is around the corner. Labor productivity continues to grow, and I would say, as you saw in some of the earlier data, this is really not driven by software engineering productivity, which is where AI has started to make an influence. This is really the bulk of the retail jobs, etc., where AI has not fully penetrated in terms of delivering the productivity, which is why we see a lot of opportunity for growth for many of the companies that we are investing in and have invested in. So what to look for? Inflation has stabilized. We're expecting a one-time bump and stable trends, but it's not at that 2%, and it's unfortunately reaching a steady state at a higher point, as it you would expect in a um, in a control system which has a delay between the signal and the final impact, or the control change and the final impact. Uh, Valuations are volatile, and the new administration policy is still not put into place. We had hoped for, and typically in a transition, all of this settles down in the Q1 timeframe. I don't think it's settling down until we get into Q3 timeframe. It's not going to settle down this quarter. Uh, the economy did shrink, but the reason why this GDP shrank was because of heavy imports, uh, and net exports is what contributes to. So net exports increase, GDP increases; imports increase, GDP decreases. Uh, Hopefully, next quarter we have lower level of imports, and so the trade deficit looks better. Trump claims a victory lap, and we can get back to running our businesses and making our investments. Federal Reserve continues to have a lot of firepower. So anytime if we start looking like we are trending towards a recession, and inflation is remaining steady, I think the Fed will act, but that's not the case right now until it changes. So those are the highlights. If you have any questions, send them my way, and there'll be links to the presentations below.